Today on The Bottom Line, the iPhone X, or is it 10, Nintendo, and Invesco's Christina Hooper. Hello everyone, welcome to The Bottom Line. I'm Henry Blodget. Today, Apple, Nintendo, bulls everywhere, and a scary concern about the market.
Also, we have Christina Hooper here from Invesco, who says tech stocks are still a good value.
The long wait is over and Apple's newest iPhone is finally here, which leaves three questions. First, is it awesome? Second, will people really pay another $200, over $1,000 for it? And then third, what does it mean for the stock price? We're joined by Steve Kovach, Chief Tech Correspondent at Business Insider. Steve, you have had the iPhone that everybody has been waiting for weeks. How is it?
I love it. I think it's the perfect form factor. 3 years ago, they brought in the bigger screens, and now they've kind of figured out how to make that bigger screen crammed onto a smaller body. And it's beautiful. It works. It's the most functional phone they've made so far. It's great.
Face ID working for you, the notch at the top that certain aesthetes are looking at and saying, oh, it's a horrible notch, it's wrecking my screen. Those things are okay?
Those things don't bother me. And in fact, Face ID was the thing I was more worried about than the notch itself. And we haven't been able to trick it. We brought identical twins into our office and it could tell them apart. We had one of our colleagues shave his beard and it could tell the difference after he shaved his beard. Darkness, brightness, you can't trick the thing.
So are people going to spend more for this? Should they wait, first of all?
It seems like they are. And what surprised a lot of people was the lack of excitement when the iPhone 8 launched a little over a month ago. There weren't lines, there wasn't a lot of hubbub, and people were thinking, oh my God, this is doom and gloom. But it turns out a lot of people were holding out for the iPhone 10 instead. So it seems like people aren't really scared away from that $1,000 price, and they're going to spend it anyway.
And Apple's hit a new high this week, all-time high on this. One of the things we've been talking about on the bottom line is that the stock tends to run up into new iPhone launches, especially around major ones like this. This is reminiscent of the iPhone 6, which was the first big screen, right. Ran up for more than a year into that. And the question is, what happens now? And one of the things we looked at this week are some of the analyst reports on this. And one thing that's interesting that's happening is that because of the supply constraints around the X, I think it's called the 10, which is so cool they call it the X, is that analysts are now saying that this might actually help the stock because it's going to prolong this upgrade cycle. And so you do think that people will wait for it?
Yeah, it's going to bleed into next quarter easily. Right now, if you were to go to the Apple Store today or online and try to order one, it's going to be a 6-week wait, and that wait time is not going to diminish, most people estimate, until well into spring. And so by the time it gets to the point where you can go into a store and buy one, we're going to be in February or March.
So it extends into next year. A couple of other points for you out there. Piper Jaffray did a survey. They found that 50% of people are planning to upgrade their iPhone this year. Compare that to last year. In normal years, it's only 35%, so expecting to see a lot there. They're forecasting an increase in the average selling price for the iPhone now that Apple has so many different price points you can buy. And then, importantly, they're not expecting everybody to buy the X. They are expecting, in fact, a lot of people to buy the 8, a lot of people to buy the 7 and earlier, and then some people to buy the top-of-the-line phone. And putting all of that together, they think that this can take the stock right to 200, which would be a $1 trillion company. So let us hope, we Apple shareholders, and I will say that I am still one of them, that we do have an extended run here into next year. A high flyer from yesteryear is now red hot again. Nintendo has hit its highest price in years. Analyst at Jefferies says, quote, it can be a multi-bagger going forward. So what is driving the price? We're joined again by Steve Kovach. Steve, what's going on with Nintendo?
It's the Nintendo Switch. This is their new console that came out in March, and it's really making up for the flub of the Wii U, their previous console. They kind of figured out that they can find this hybrid gaming between mobile and television gaming. You dock it into your TV, you can play on your television big screen, and then you can snap it out of the dock and take it on a plane or on the subway on the go, and that seems to be really resonating with people.
And if you look at the stock price over the long term, what you find is that, in fact, we had it sort of come down from the early 2000s, then a big run up into 2007 timeframe, which was when the Wii launched.
That was the original Wii.
Right. Then you talk about the flop in between. Now we have the Switch. So what you've just described is that this console is a hybrid between mobile games and TV games, and ultimately they seem to have found a great point in the market.
Exactly. This was the thing critics have said Nintendo needs to nail for years. Put games on the iPhone, get mobile friendly. They're finally starting to do iPhone games and Android games, and then they're making their own console more mobile friendly as well. On top of that, they're releasing blockbuster games. There's a new Zelda game that launched with the console, a new Mario game that just came out, and those are easily best games of the year, maybe even of the decade.
And explain to me, Mario seems old even to me, like distant memory banks.
30 years.
I remember
Yeah.
Mario. So what is up with that? How can a new Mario game possibly be fun?
It's
in this day
IP.
and
Well,
age?
first of all, it's IP. So they have this great IP around Mario and Zelda and Donkey Kong and all those people. And so it's like Disney characters, but for video games. On top of that, they're doing a lot of innovative things, new kinds of patrol mechanisms, big, expansive open worlds. It's a very innovative new kind of Mario game. It's not the one that you played back in 1985 where you're just side-scrolling. This is huge, great graphics and great gameplay, and it's a unique experience. It's not just a boring old Mario game or something.
And we all remember, I think it was about a year ago when Pokemon Go came out. It was a fascinating new game. It's this suddenly augmented reality is a reality. Listening to the analyst at Jefferies, Atul Goyal, he says that, look, the near-term driver of Nintendo is the Switch, and we're early in that cycle. He thinks a lot more consoles are going to be bought and all the games will be layered on. But longer term, mobile games will drive it. And he says Nintendo has learned a lot from the Pokemon Go experience. Do you think that augmented reality gaming will be huge?
Well, just mobile gaming, it's not just Pokemon Go. You look at what they did with Super Mario Run. Instead of just tacking on a console game onto the iPhone, which is what everyone wanted them to do, they said, let's look, we have this great IP, we have Mario, we have Zelda, let's figure out how we can make that fit onto mobile and make the gameplay make sense on mobile. And that's what they've done. That's what they did, helped to do with Pokemon. That's what they did with Mario. They have a new game called Animal Crossing, which is also another popular franchise. And it's not a typical console-type game. It's really leveraging how you control things on a phone. And that's why those games have been successful. So you're seeing a lot of experimentation on that. And of course, if it's $10 or $15, as long as it has a Nintendo character on it, people are going to pay for it.
Steve, thank you. Great to have you.
Thank you.
Stock market appears unstoppable, but when you have a trend like this, it often helps to look for what could derail it. Business Insider's Joe Cioli had one concern that Wall Street's increasingly focused on, which is low cash levels. A couple of the brokerage firms say that we are at record low cash levels relative to equities. In the past, 2007, 2000, readings like this have sometimes correlated with a peak in the market, so raising concerns. Goldman Sachs, on the other hand, says, hey, nothing to worry about. Look at the big picture. We're within normal levels. Sarah Silverstein, you are with the bulls on this.
I am, and I'm not always with the bulls, but I do believe Goldman's story that 15% of household assets are in cash right now, and I just think that the other financial firms, they're measuring the private wealth clients, and I think people just don't want to pay to hold their cash anymore. So either banks are calling it something else and they're actively managing their low-risk investments, or people aren't putting it with their private wealth managers to hold for them. I just don't believe that everybody has 2% in cash.
But Ms. Silverstein, isn't it true that at the peak of bull markets, when everybody is the most enthusiastic and they can't stand not being a part of the stock market, they invest everything they've got right at the peak, and it's always the worst time? Couldn't that be what's going on?
Absolutely, that absolutely could. But right now, if you look at, even if you believe all these numbers, which even if you do, that's fine. But leverage, like we've been deleveraging this whole time. So we still have less money in the markets, in my opinion. And yes, that happens at the peak, but I feel like there's still more money you could squeeze out of it.
Forever bullish, Sarah Silverstein. No worries on the cash side.
Jurian Timmer, Director of Global Macro for Fidelity Management and Research, has a new research note out. He says, yes, earnings have started to decelerate, but they still look good. He also says he doesn't think that sentiment has reached bubble levels yet. But here are the two big risks that he is looking out for if there is some shock to the system. He says that one could be a hard landing in China. If tighter policy could cause global earnings, the entire global earnings picture to sour, which could bring down stock prices around the world. The other thing he's looking out for is higher rates. If the Fed or other central banks tighten more than the market is currently pricing in, then that could put downward pressure on valuations. He says this is only likely to happen if inflation forces the Fed's hand. But as we've all seen, the market and the Fed have very different ideas of what the rate hike picture is going to look like. So 2 things to watch out for, the Fed and China, and that is today's Fidelity Insight. I'm here with Christina Hooper, Global Investment Strategist at Invesco. Thank you so much for joining me.
Thank you so much.
So the first thing I want to ask you about is market valuations. Can this bull keep going, or have we reached a point that it's enough?
Well, this bull can go on for a while, but I do think every day this rally continues, there's more vulnerability. Right, we've got very stretched valuations, 17.9 times trailing PE, so that is a little scary, and we've got that compared to a 10-year average of 14.1 times earnings. So there's vulnerability there. Also because I would argue that so much of the run-up has been due to expectations. You could almost say that the stock market is priced for legislative perfection, and I'm not sure we're going to get close to legislative perfection. So there's vulnerability there. But that doesn't mean the stock market can't run. In fact, there are 2 key drivers. Still very accommodative monetary policy, as well as a global economic growth environment. That's pretty significant.
And one of the things that you have 3 things that you say that could disrupt the current equity environment. What are those?
Well, there are, and this is really more to think about over the longer term, but there are 3 drivers of disruption going forward. One we've already seen a lot of, and that's geopolitical disruption, right? We have great wealth inequality, which has led to a lot of populism, movements around the world focused on deglobalization, and that can create some level of disruption. We've already seen a bit of that with the Brexit negotiations, and in general, I think geopolitical disruption is something we want to pay attention to, whether it's North Korea or in the U.S. But then also we have added to that the potential for monetary policy disruption. Because we've lived through this for the last 10 years, I don't think many people take a step back and realize just how experimental what we've been through is. But this really was an experiment. I mean, the idea of QE, large-scale asset purchases by a central bank, that was as obscure as helicopter money back a few decades ago. And then really as a result of our desperation post-global financial crisis, we invoked QE, and now we have this giant balance sheet. We went from $800 billion to $4.6 trillion. Now we have to unwind it. We have to realize that there were a lot of unintended consequences as the balance sheet grew, and there could be some unintended consequences as we normalize the balance sheet. So while my base case is not monetary policy disruption, I do think there's a distinct minority case for monetary policy disruption, so we're going to want to watch that closely. And then finally, the third theme, which is probably the most long-lasting of the 3, is innovation-driven disruption. Right, we're on the cusp of a lot of technological innovation. I think of driverless cars and how before we know it, we're going to see them being tested in New York City. We're going to be seeing just more of a proliferation of them. Think about artificial intelligence, how that's changing and disrupting industries. That's likely to have one impact on the economy in terms of structural unemployment. The Uber driver in 4 years might not have a job. Similarly, we saw a newspaper delivery person who is probably losing their job today because most people are getting newspapers delivered on their iPads. So we're going to be experiencing a lot of structural changes in our economy, which are going to contribute to a higher level of structural unemployment. I think that's why tech CEOs have been advocating for basic income, because maybe there will be a day in a few decades where more income is derived from capital than from labor. And that actually creates even greater wealth inequality gaps.
In the first question, you mentioned that the market is priced based on legislative perfection. Can you tell me, what is the one thing that could make that all fall apart? What is that most dependent on?
So I think it's most dependent upon the corporate tax cut portion of this large tax plan. And what I would say is what we've seen thus far is something of a wish list. and that we're likely to see a lot of negotiation, bartering, horse trading. What needs to be preserved is that 20% corporate tax rate as well as the immediate expensing of capital investment. That's what directly impacts companies, their balance sheets, their earnings, and so to me, that's what needs to come to fruition in order to support the stock market.
And it seems like the market thinks that will happen. Do you think that's going to happen?
I think there's a better chance than not, but I do think that there are a lot of obstacles between here and there. And I will also point out that Wall Street analysts are very, very good at crunching numbers. The wheelhouse is going through numbers and figuring out exactly what's going to happen. But it's a lot harder to do analysis of where votes will come from in Congress and how exactly different factions of Congress will shape a tax reform bill. So once we know that there's a bill and it will be voted on, it becomes easier. And certainly once that bill is voted on, it's much easier to assess the impact to individual companies. But right now we're in a stage where it's pretty much a guessing game.
And when we look at the stretch valuations, is there any places where you see value in the markets, either in the US or globally?
So there's certainly a lot of value to be had globally, but there's also some value to be had in the US. Now globally, if we were to just look at different indices, what we'd see is lower valuations. Even the emerging market space, the MSCI Emerging Markets Index, has a lower valuation than that of the S&P 500, and it has higher growth rates. So what I would say about the EM space is it's a wonderful addition to a portfolio. It's a great complement to domestic stocks. It'll actually lower overall valuations, bring up growth rates, but it's also true that, for example, international developed markets, particularly in Europe, look attractive because expectations are so low. And so valuations are low. We don't see an awful lot of growth there, but we see growth that's exceeded recent expectations. And so to me, this is the kind of environment where even though diversification hasn't really paid off in the last few years, diversification will pay off in terms of being well diversified internationally, but also having additional asset classes in one's portfolio. Now within the US, there are still bargains to be had. And also I would say there are areas where we want to pay for growth. And so, for example, tech stocks still look very attractive. Valuations are not sky high when you compare them to historical valuations over the last decade, last 2 decades. And in addition, those are areas where we're seeing pretty significant earnings and revenue growth over the next year or two. So it's a good place to be. Also dividend-paying stocks. I mean, one message that comes through loud and clear about current monetary policy is that it's still accommodative. It's only going to slowly get less accommodative. And to me, this is an environment where rates are going to be lower for longer. So that means the hunt for income continues. And one way to get income is through dividends. So to me, dividend-paying stocks, especially those companies that are increasing their dividends, that have generous dividends, that's an area to be focused on in the US.
Right, and my last question for you, is there one piece of advice you would give to the new Fed chair?
Well, I think that when the history books are written about monetary policy, particularly monetary policy post-global financial crisis, they're going to be kind to Janet Yellen. And they're going to say that data-dependent rate hikes made sense for this kind of environment. The idea that Janet Yellen is looking at a mosaic of data as opposed to just a few factors. Even the way she looked at unemployment and the labor market, she didn't just look at the unemployment rate, she looked at the labor market conditions index. And so to me, getting an understanding of the bigger picture and looking at all the different variables in the economy. For example, we have a very significant portion of America that really hasn't participated in this recovery. And so to try to find ways to factor that into monetary policy makes sense. And so my advice to the next Fed chair is to not throw out the baby with the bathwater, to really have an appreciation for some of the policies, that careful thoughtfulness that helped steer us through the last decade, and to try to adopt a lot of that, Data-dependent monetary policy to me makes sense. Being very careful and thoughtful about balance sheet normalization makes sense. And so hopefully there will be some continuation of those policies going forward.
Great. Christina, thank you so much.
Thank you.
That's it for this week. Thanks very much for joining us.
Thanks to Fidelity Investments for making the show possible.
And thanks to NASDAQ for hosting us in Times Square. We'll see you next week.